Before we begin, a quick disclaimer. I am not a licensed financial advisor or insurance agent. This presentation is for informational and educational purposes only. The information provided is not intended to be a substitute for professional financial or legal advice. You should always consult with a qualified and licensed professional before making any decisions about your insurance coverage. Your personal situation is unique, and the information in this video may not be applicable to your specific circumstances. Imagine this for a second. You're driving home from work, music's playing, you're thinking about dinner. You approach a green light and suddenly out of nowhere, bam! A car blows through the red light and T-bones you. The sound is deafening. Your car is a twisted wreck. Thankfully, you're mostly okay, just shaken up. But when you finally talk to your insurance company, they deliver the news that hits you like a second collision. The specific coverage you thought you had, you don't. And that one little box you didn't check on your policy is about to cost you $10, $15, maybe $20,000 out of your own pocket. This isn't a scare tactic. It's a reality that plays out in every city, in every state, every single day. And it happens because most of us treat car insurance like a utility bill, something we just have to pay without ever truly understanding what we're paying for. We click get a quote, pick the cheapest option and hope for the best. That hope is not a strategy, and today that changes. By the end of this video, you are going to understand the 5 fundamental pillars of auto insurance. We're going to strip away the confusing jargon and the legal maze and give you the clear, simple knowledge you need to protect yourself, your family, and your financial future. You will learn how to read your own policy, spot the dangerous gaps, and make sure you're not paying a single dollar for a false sense of security. We are going to turn you from an insurance amateur into a confident, savvy consumer who is in complete control. So let's get into it. The 5 basics you absolutely must know are liability coverage, collision coverage, comprehensive coverage, uninsured and underinsured motorist coverage, and finally medical payments or personal injury protection. We're going to tackle the first and arguably the most important one right now, liability coverage. If you remember only one thing from this entire video, let it be this: liability insurance is not for you. It does not cover you, your injuries, or your car. Liability coverage is for the other guy. It pays for the damage you cause to other people and their property if you are at fault in an accident. Think of it as your financial shield. If you cause a crash, the other driver, their passengers, and anyone else involved can, and often will, sue you. They'll sue you for their medical bills, their lost wages, their pain and suffering, and the cost to repair or replace their vehicle. Without liability coverage, they would come after your personal assets, your savings account, your investments, your house, even your future earnings. Liability coverage is the wall that stands between a bad day on the road and total financial devastation. Now, liability is broken down into 2 key parts: bodily injury liability and property damage liability. When you look at your insurance policy, you'll see a series of 3 numbers like 25/50/25, or 50/100/50, or maybe 100/300/100. This isn't a secret code. It's the key to your entire financial shield, and understanding it is non-negotiable. Let's break down what 50/100/50 actually means. The first number, 50, stands for $50,000. This is the maximum amount your insurance company will pay for any one person's bodily injuries in an accident that you cause. This covers their hospital bills, ambulance rides, physical therapy, and so on. If you hit a car and the driver's medical bills are $40,000, you're covered. But if their bills are $70,000, your policy pays out the max of $50,000, and you are personally on the hook for the remaining $20,000. The second number, 100, stands for $100,000. This is the maximum total amount your insurer will pay for all bodily injuries combined for a single accident. Let's say you cause a multi-car pileup. One person has $50,000 in medical bills, another has $40,000, and a third has $30,000. That's a total of $120,000 in medical expenses. Your policy has a cap of $100,000 per accident, so it pays out that $100,000, and guess who gets the bill for the other $20,000? You do. The third number, the final 50, stands for $50,000. This is the maximum amount your policy will pay for all property damage you cause in one accident. This is mostly for the other person's car, but it also covers anything else you might damage: a mailbox, a storefront, a city guardrail. Now, here is the most dangerous trap that millions of Americans fall into. Every state has a legal minimum amount of liability coverage you're required to have. In some states, it's as terrifyingly low as 25/50/25 or even less. People see this and think, great, I'll just get the legal minimum. It's the cheapest option, and it keeps me legal. This is one of the biggest financial mistakes you can make. Let me paint a picture for you. Let's say your state minimum for property damage is $25,000. You're driving, you get distracted for just 1 second, and you rear-end a brand new Ford F-150. Not a Ferrari, not a Lamborghini. A Ford pickup truck, one of the most common vehicles on the road. The average transaction price for a new F-150 is over $60,000. You just caused $60,000 worth of damage. Your legal insurance policy pays out its maximum of $25,000. The other driver's insurance company then turns around and sues you personally for the remaining $35,000. And they will get it. They will garnish your wages, put a lien on your property, and drain your savings. All because you tried to save maybe $10 or $15 a month on your premium. It's even worse with bodily injury. One single night in a U.S. hospital can cost thousands of dollars. An ambulance ride, an MRI, a surgery, you can blow past a $25,000 or $50,000 bodily injury limit before the patient is even discharged. If you cause an accident that results in a serious life-altering injury, the medical bills and lawsuits can easily climb into the hundreds of thousands, if not millions of dollars. Your state minimum policy will be exhausted in a heartbeat, leaving your entire life's work exposed. So what's the solution? You need to carry liability limits that are high enough to protect your actual net worth. A common recommendation from financial experts is to have at least 100/300/100. That's $100,000 for one person's injuries, $300,000 for all injuries in an accident, and $100,000 for property damage. For many people, especially homeowners or those with significant savings, even that isn't enough. Many advisors suggest 250/500/100 as a much safer baseline. And here's the kicker. The price difference between dangerously low state minimum coverage and robust, asset-protecting coverage is often shockingly small. We're not talking about doubling your premium. In many cases, you can quadruple your protection for maybe $20, $30, or $40 more per month. It is the single best investment you can make in your financial security. You work your entire life to build something for yourself and your family. The idea of losing it all because you wanted to save the price of a few cups of coffee each month is just unthinkable. So your first piece of homework is to pull out your own insurance policy. You can probably find it online in about 2 minutes, and look for those 3 numbers. What is your liability coverage? Is it a flimsy state minimum shield? Or is it a fortress that can actually protect what you've worked so hard to build? If it's too low, your number 1 priority should be to call your agent or go online and increase it. Today, liability is about protecting everyone else from the damage you might cause. It's the responsible, foundational piece of your policy, but it does absolutely nothing to fix or replace your own car. If you cause that accident and your car is totaled, liability coverage will give you $0 to buy a new one. For that, you need a completely different type of protection. And that brings us to the second pillar you must understand: collision coverage. Collision coverage. Think of it as the shield for your own car. Let's go back to that accident scene. You've just rear-ended someone. Your liability coverage is busy taking care of their car and their injuries, like a dedicated butler serving another family. But you're standing on the side of the road, looking at the crumpled front end of your own vehicle. Your butler liability just shrugs and says, "Sorry, you're not on my list." This is where collision coverage swoops in. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it rolls over. The key phrase here is collision with another object. That usually means another car, but it also covers you if you back into a pole, hit a guardrail, or swerve to miss a squirrel and hit a mailbox. And here's the most important part. It pays out regardless of who is at fault. Whether you caused the accident or you were the victim of a hit-and-run, collision has your back. It's the coverage that fixes your car. Now, it doesn't just hand you a blank check. There's a catch, and it's called the deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a single dime. It's your skin in the game. Let's say you have a $500 deductible. You get into an accident that causes $4,000 worth of damage to your car. You pay the first $500 to the body shop, and your insurance company covers the remaining $3,500. If the damage was only $400, well, that's less than your deductible, so you're paying for that repair entirely on your own. Your insurance isn't involved. You get to choose your deductible amount, and this is a critical decision. Common options are $250, $500, $1,000, or even more. And here's the trade-off, the fundamental law of insurance. The higher your deductible, the lower your monthly premium will be. Why? Because by choosing a higher deductible, you're telling the insurance company, I'm willing to take on more of the financial risk myself in a small accident, so you don't have to. They reward that risk-taking with a lower price. Conversely, a low deductible like $250 means your premium will be higher, because the insurance company is on the hook for almost any little scrape or fender bender. It's a balance between what you can afford to pay per month versus what you could realistically afford to pay in a lump sum after a surprise accident. But what if the damage is really, really bad? What if the mechanic looks at your car and just shakes his head, saying it's a total loss? This is when the insurance company declares your car totaled. It means the cost to repair the vehicle is more than the vehicle is actually worth. In this case, they won't pay for repairs. Instead, they will write you a check for the value of your car. But here's a detail that trips up millions of people and leads to a lot of frustration. They don't pay you what you paid for the car. They don't pay you what it costs to buy a brand new one. They pay you the actual cash value, or ACV, of your car the microsecond before the crash happened. Actual cash value is a fancy term for the car's market value, taking into account its age, mileage, condition, and depreciation. So if you were driving a 7-year-old car that you loved, but its market value was only $8,000, the absolute most your insurance company is going to give you is $8,000 minus your deductible. If you had a $1,000 deductible, you're getting a check for $7,000. That's it. That's the money you now have to go out and find a new car. This is one of the harshest realities of insurance, and understanding ACV is key to setting your expectations correctly. So, liability protects everyone else. Collision protects your car from, well, collisions. We're covered, right? Not even close. Imagine this. You wake up one morning and walk outside to a nightmare. A massive hailstorm hit overnight, and the roof and hood of your car now look like a golf ball. Or a huge branch from your neighbor's oak tree snapped in a windstorm and crushed your windshield. Or maybe you're driving down a country road at dusk, and a deer makes the last mistake of its life, and in the process destroys the front of your car. What about theft? What if you come back to a parking spot and find just a pile of broken glass where your car used to be? Or fire? Or a flood? None of these scenarios involve a collision, in the way insurance defines it. You didn't hit another object, so your collision coverage won't do a thing. This is where the third pillar of protection comes in, and it's called comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It's the catch-all for almost all the other ways your car can be damaged or destroyed. It's your protection against the random, unpredictable chaos of the world. That hailstorm? Covered. The falling tree branch? Covered. Hitting that deer? Yes, hitting an animal is covered under comprehensive, not collision. That's a weird quirk, but it's a crucial one to know. Vandalism, theft, fire, floods, riots. All of these fall under the comprehensive umbrella. Just like collision, comprehensive coverage has a deductible. You choose the amount $250, $500, $1,000, and it works the exact same way. If a thief breaks your window and it costs $600 to replace, and you have a $500 deductible, you'll pay the $500 and insurance will pay the last $100. You can even have different deductibles for each coverage. You might choose a $500 collision deductible because accidents are more common, but a $1,000 comprehensive deductible because you live in a safe area where theft or weather events are rare. Now, you've probably heard the term full coverage. You might even think you have it. But I have to tell you, full coverage is a myth. It's not an actual insurance product. It's a slang term, a shorthand that people use. When someone says they have full coverage, what they almost always mean is that they have a policy that includes all three of these pillars: liability, collision, and comprehensive. It's the holy trinity of standard auto insurance. But it is far from covering you for everything. And knowing when you need this trinity is a massive financial decision. First, the easy part. If you have a loan on your car or you're leasing it, you don't have a choice. The bank or finance company that technically owns your car is going to require you to carry both collision and comprehensive. They're protecting their investment, your car, from being destroyed before you've paid it off. For them, it's non-negotiable. But what if you own your car outright? What if you're driving a 10-year-old Honda that's been paid off for years? Do you still need collision and comprehensive? Maybe not. This is where you have to become your own financial advisor. You have to do a cost-benefit analysis. First, look up the actual cash value of your car. Go to a site like Kelley Blue Book and get a realistic private party value. Let's say your trusty old car is worth about $3,000. Now look at your policy. Let's say you have a $1,000 deductible for both collision and comprehensive. This means that if you total your car, the absolute maximum payout you will ever receive is $2,000. That's the $3,000 value minus your $1,000 deductible. Now ask yourself, how much are you paying per year for those two coverages? Let's say it's $500 a year. Are you willing to pay $500 every single year for the possibility of a $2,000 payout? Over 4 years, you would have paid $2,000 in premiums just to protect a car that's worth $3,000. For some, that peace of mind is worth it. For others, it makes more financial sense to drop those coverages, bank the savings, and accept the risk that if the car gets totaled, they'll have to cover the replacement cost themselves. There is no right answer, but it's a calculation you absolutely must make for any paid-off vehicle. So now you understand the 3 core protections: liability to protect your assets from others, and collision and comprehensive to protect your own car. You're starting to see how the pieces fit together to form a shield. But that shield has some very specific, very dangerous holes in it. We've built our entire plan around the idea that if someone else hits you, their liability insurance will pay for your car and your medical bills. It's a system that works, until it doesn't. What happens when the driver who plows into you has no insurance at all? Or they have the absolute bare minimum coverage from their state, which is barely enough to cover a dent, let alone your hospital stay? Suddenly, their insurance is worthless, and you're the one left holding the bag for everything. That's a terrifying thought, and it's why our next 2 pillars of protection are not just important, they are absolutely essential. So let's talk about those 2 essential pillars. The first one is designed to protect you from the ghosts on the road, the drivers who shouldn't be there in the first place. I'm talking about uninsured motorist coverage. Imagine this. You're driving home late one night, minding your own business. The light turns green, you proceed through the intersection, and bam! Out of nowhere, a speeding truck runs the red light and T-bones your car. The impact is violent. Your world spins. When you finally come to, you see the truck peeling away, its taillights disappearing into the darkness. A hit and run. You're rushed to the hospital. You have a broken arm, severe whiplash, and deep bruising. Your car? It's completely totaled. The police can't find the driver. They were a ghost. They caused this chaos and vanished, leaving you to deal with the aftermath. Now, who pays for this? Who pays for the ambulance, the emergency room, the surgery on your arm, the months of physical therapy? Who pays for the wages you'll lose because you can't work? And who is going to replace your $1,000 car? If you only have liability insurance, the answer is horrifyingly simple: you do. All of it. Your liability coverage only pays for damage you cause to others. It does absolutely nothing for you in this situation. Your health insurance might cover some of the medical bills, but what about your high deductible? Your co-pays? And it certainly won't give you a dime for the fact that you can't go to your job, or for the pain and suffering of a long recovery. It won't replace your car. You are left, through no fault of your own, in a potential pit of financial ruin. This is where uninsured motorist coverage, or steps in and becomes your financial superhero. Uninsured motorist coverage acts as the insurance the other driver should have had. It pays for your injuries, your medical bills, and your lost wages when you're hit by someone with no insurance, or in a hit and run where the driver can't be found. It's a shield you carry for yourself. There are 2 parts to it. Uninsured motorist bodily injury (UMBI) covers your medical expenses, pain and suffering, and lost income. Uninsured motorist property damage (UMPD) can cover the repairs to your car. Now, some states don't offer UMPD because they expect you to use a different type of coverage, which we'll cover in the next part. But the bodily injury part is the absolute non-negotiable lifesaver here. You might be thinking, but wait, car insurance is mandatory in my state. And you're right. But that doesn't stop people from breaking the law. The Insurance Research Council estimates that a staggering 1 in 8 drivers on the road is uninsured. That's nearly 13% of the cars you pass every single day. That's like playing Russian roulette with your finances every time you get behind the wheel. Having uninsured motorist coverage is like taking the bullet out of the chamber. But what about the other scenario? The one where the driver who hits you does have insurance, but they only have the bare minimum required by law? This brings us to our 4th pillar: the equally critical twin to coverage, Underinsured Motorist Coverage, or UIM. Let's change the scenario. You're in that same accident. The truck T-bones you, but this time the driver stops. He's apologetic, he has an insurance card, and he admits fault. You feel a wave of relief. At least he's insured. But that relief is about to vanish. You get the hospital bills. After the surgery, the rehab, the follow-up appointments, the total comes to $150,000. Plus, you've missed 3 months of work, which is another $20,000 in lost wages. Your total damages are $170,000. Then you get the call from the at-fault driver's insurance company. They tell you his policy has a bodily injury liability limit of $25,000 per person. That's the state minimum. They cut you a check for the full $25,000, and then they say, "We're sorry, but that's all we can do. Our obligation is fulfilled." You're staring at a check for $25,000, and you have bills and losses totaling $170,000. That leaves a gap of $145,000. A devastating, life-altering amount of money that you are now on the hook for. Their insurance wasn't worthless, but it was so inadequate it might as well have been. This is the exact nightmare scenario that underinsured motorist coverage is built for. Underinsured motorist coverage kicks in when the at-fault driver's liability limits are not high enough to cover your damages. Your UIM coverage pays the difference, up to the limit you selected on your own policy. So let's rewind that accident. This time you were smart. When you bought your insurance, you chose underinsured motorist coverage with a limit of $250,000. Now, when the other driver's insurance pays their $25,000 max, your UIM coverage steps in to cover the rest. That $145,000 gap? It's gone. Covered by your own policy. Your medical bills are paid. Your lost wages are reimbursed. You can focus on healing, not on bankruptcy. Uninsured and underinsured motorist coverages are the two most important protections you can buy for yourself and your family. They are your personal safety net in a world of irresponsible or underprepared drivers. They are often sold together as a package, UM/UIM, and in some states they're even required. But even if they're optional in your state, skipping them is one of the biggest gambles you can possibly take. So how much should you get? The rule of thumb is simple and powerful. You should have at least as much UM/UIM coverage as you have bodily injury liability coverage. Think about it. If you believe you need $100,000 of liability coverage to protect your assets in case you hurt someone else, why on earth would you accept less than that to protect yourself if they hurt you? You are protecting the exact same assets, just from a different direction of attack. Match your liability limits. It is the single best piece of advice I can give you. And here's a pro tip that almost nobody knows about. Ask your agent about stacking. In many states, if you have multiple cars on your policy, you can stack your UM/UIM coverage. For example, if you have $100,000 of coverage in 3 cars, stacking it could potentially give you $300,000 of total protection for a very small increase in your premium. It is, without a doubt, one of the best bargains in the entire world of insurance. So we've now built a fortress. We have liability to protect us from devastating lawsuits if we cause an accident. And we have uninsured and underinsured motorist coverage to protect us from the financial fallout if someone else causes an accident and can't pay. We've protected our assets and our bodies from the actions of others. But there's one giant, expensive piece of the puzzle we haven't talked about protecting yet. It's the thing this is all centered around. It sits in your driveway every night and can be worth $10,000, $20,000, even $50,000 or more. I'm talking about your car itself. What happens when it gets damaged? Whether it's your fault or an act of God, that requires a completely different kind of armor, and it's the 5th and final pillar we need to put in place. This armor for your car is actually a 2-part shield. Think of them as 2 distinct but equally crucial pieces of protection: collision coverage and comprehensive coverage. Let's break down the first one because its name is pretty straightforward. Collision coverage is your financial bodyguard in a crash. It pays to repair or replace your car if it's damaged in a collision with another object. That object could be another car, of course, but it could also be a tree, a guardrail, a telephone pole, or even a pothole that sends you into a curb. The most important thing to understand about collision coverage is this: it pays out regardless of who is at fault. Let me repeat that because it's the whole point. Collision coverage protects you even if you are 100% to blame for the accident. Let's say you're backing out of a tight parking spot at the grocery store. You're checking your mirrors, you're looking at the backup camera, but you misjudge the distance and you crunch your rear bumper into one of those concrete pillars. It's a classic stomach-dropping moment. Nobody else is involved. It's entirely on you. Your liability insurance, which we talked about before, does absolutely nothing in this situation. It's designed to pay for damage you do to other people. It won't give you a single dime to fix your own car. But if you have collision coverage, you can breathe. You file a claim, and your insurance company will pay for the repairs to your car. Or imagine you're driving on a slick, rainy night. You take a turn a little too fast, the car hydroplanes, and you slide into the median. Again, it's a single car accident. Your fault. Without collision coverage, you're looking at a tow truck bill and a massive repair bill that you have to pay entirely out of your own pocket. With collision coverage, you're covered. Now, this coverage isn't a magic blank check. There's a key piece to this puzzle called the deductible. The deductible is the amount of money you have to pay out of pocket before the insurance company starts paying. Think of it as your share of the risk. Deductibles typically range from $250 to $1,000, or even higher. The most common is $500 or $1,000. So, let's go back to that parking garage scenario. You get an estimate from the body shop, and it's going to cost $3,000 to replace the bumper and fix the paint. If you have a $500 deductible, you pay the first $500, and the insurance company pays the remaining $2,500. If you have a $1,000 deductible, you pay the first $1,000, and the insurance company pays the other $2,000. You get to choose your deductible level when you buy your policy, and this is a critical decision. A lower deductible, say $500, means you'll pay less out of pocket if you have an accident. But it also means you'll pay a higher premium every month. A higher deductible, like $1,000, means you'll have a lower monthly premium, but you'll have to come up with more cash yourself if you need to file a claim. It's a trade-off between short-term savings and long-term risk. We'll dive deeper into how to choose the right deductible for you in a later part. But for now, just know that collision coverage and deductibles go hand in hand. So that's the first piece of the shield. Collision protects you from crashes. But what about all the other crazy things that can happen to a car that don't involve a collision? What about the stuff that feels completely out of your control? This is where the second piece of the shield comes in. Comprehensive coverage. The official name for it is actually other than collision coverage, which is a perfect description. It covers damage to your car from almost anything other than a collision. This is the coverage for the unexpected, the bizarre, the act of God moments. Let's run through some scenarios. You're driving down a country road at dusk, and a deer leaps out in front of you. You can't avoid it. Hitting an animal is not considered a collision. It's covered under comprehensive. A massive hailstorm rolls through your town and turns the hood and roof of your car into a dimpled piece of modern art. That's comprehensive. You park your car downtown overnight and wake up to find a window smashed and your stereo stolen. Vandalism and theft? That's comprehensive. A tree branch snaps during a windstorm and lands on your car. A flash flood sweeps through your neighborhood. A fire. All of these are covered by comprehensive. It's the part of your insurance that protects your car from the world itself. Just like collision coverage, comprehensive coverage also has a deductible. It works the exact same way. If that hailstorm causes $4,000 in damage and you have a $1,000 comprehensive deductible, you pay the first $1,000, and your insurance pays the next $3,000. Often, people choose to have different deductible amounts for collision and comprehensive. For example, you might have a higher deductible for collision since those claims are often more expensive and more likely to be your fault, and a lower one for comprehensive. Now, you've probably heard the term full coverage. You go to a dealership and the finance guy says, "Don't worry, the bank requires you to have full coverage." Here's a major industry secret. Full coverage doesn't actually exist. It's not an official insurance product. You can't call your agent and say, "Sell me one full coverage." It's just slang. It's a convenient shorthand that people use to describe a policy that includes three main things. Liability insurance, to protect you from lawsuits; collision insurance, to protect your car in a crash; and comprehensive insurance, to protect your car from everything else. When you have these three pillars together, that's what people are talking about when they say full coverage. So, who actually needs collision and comprehensive? Unlike liability insurance, which is required by law in nearly every state, no state legally forces you to buy collision or comprehensive coverage. If you own your car outright, meaning you've paid it off completely, and you have the title in your name, the choice is entirely yours. However, if you have a loan on your car or if you're leasing it, your lender or leasing company will almost certainly require you to carry both. And it makes perfect sense when you think about it from their perspective. Until you pay off that loan, the bank is a part owner of your car. It's their asset, their collateral. They need to protect their investment. They need to know that if you total the car, there will be money from the insurance company to pay off the loan. They can't risk you wrecking a $40,000 car that they financed and then just walking away, leaving them with the loss. So they mandate that you keep the car fully covered until it's fully yours. This brings us to the most important strategic question of all. If you own your car free and clear, and the law doesn't require these coverages, should you still pay for them? This isn't a simple yes or no answer. It's a calculated financial decision. It involves weighing the value of your car against the cost of the insurance. For a brand new $50,000 SUV, the answer is obvious. But what about for a 12-year-old sedan with 150,000 miles on it? A car that's only worth $3,000 on a good day. Does it make sense to pay $800 a year in premiums to protect it? At what point does this essential armor become a complete waste of money? To answer that, we need to do some simple math and understand how insurance companies decide if your car is even worth fixing. This is the central calculation that dictates the fate of your vehicle. It's called the total loss formula, and it's surprisingly simple. An insurance company will declare your car a total loss if the cost to repair it, plus its remaining salvage value, is greater than its actual cash value. Let's break that down piece by piece because each part is critical. First, actual cash value or ACV. This is the single most misunderstood concept in all of car insurance. ACV is not what you paid for the car. It's not what a brand new version of your car costs. And it's not what you feel your car is worth because you took such good care of it. Actual cash value is the fair market value of your vehicle, the microsecond before the accident occurred. It's what a willing buyer would have paid a willing seller for your exact car, in its pre-accident condition in your local market. How do they figure this out? They don't just pull a number out of thin air. They act like a digital real estate appraiser for cars. They use massive databases to find recent sales of vehicles that are nearly identical to yours. Same year, make, model, trim level, similar mileage, same options packages, and in the same geographical area. They adjust for the condition you claimed your car was in. Was it excellent, good, or fair? Be honest, did it have dings, stains, or a check engine light on? All of that gets factored in. The result of all this data crunching is the ACV. It is the cold, hard, depreciated market value. This number is the absolute ceiling on what the insurance company will ever pay for your car. The second piece of the formula is the cost of repairs. This is what the body shop estimates it will take to bring your car back to its pre-accident condition. And this number can skyrocket faster than you think. It's not just the dented fender you can see. It's the sensor behind the bumper, the bent radiator support you can't see, the cost of specialized labor, the paint matching, and then, inevitably, the dreaded supplement. That's when the shop takes the car apart and finds more hidden damage, adding thousands to the initial estimate. The final, secret ingredient is salvage value. This is the aha moment for most people. Even when your car is a mangled wreck, it's still worth something. It's a pile of parts. The engine, the transmission, the catalytic converter, the wheels, all of these can be stripped and sold. The insurance company knows exactly what they can get for your wrecked car by selling it at a salvage auction. This salvage value is money they can recoup. It's an asset to them. Now let's put it all together with an example. Let's say you have a 10-year-old sedan. You love it, it's been reliable, but its actual cash value according to the market data is $4,000. You get into a fender bender. The initial estimate from the body shop is $2,500. You think, great. The ACV is $4,000. The repairs are only $2,500. They'll definitely fix it. But then the body shop calls. They found a crack in a unibody frame rail. The new repair cost is now $3,500. Still under the ACV, right? You'd think they'd fix it. But the insurance adjuster does one more calculation. They know that even in its wrecked state, they can sell your car to a salvage yard for $700. So they run the formula. Is the cost of repairs $3,500 plus the salvage value $700 greater than the actual cash value $4,000? Let's see, $3,500 plus $700 equals $4,200. Yes, $4,200 is greater than $4,000. Boom. Your car is a total loss. From the insurer's perspective, it's simple business. Why would they spend $3,500 to repair your car when they could just write you a check for $4,000, take your car, sell it for $700, and be out a net of only $3,300? They just saved $200 by totaling your car. It feels personal and devastating to you, but to them it's just an equation. And to make it even more complicated, this formula isn't even universal. The decision to total a car is also governed by state law. Some states use that formula we just described, but others use a simple percentage. This is called the total loss threshold. In a state like Iowa, for example, if the repair costs reach just 50% of the car's ACV, it can be declared a total loss. In New York, it's 75%. In Texas, it's 100%. So the exact same car with the exact same damage could be repaired if you crash in Houston, but be sent to the scrapyard if you crash in Des Moines. You need to know your state's threshold. So now that you understand the brutal math of actual cash value and the total loss formula, we can finally answer the question, when do you drop collision and comprehensive? The answer becomes a simple risk-reward calculation based on your car's ACV. Here's a 3-step process you can do right now. Step 1. Get a realistic estimate of your car's ACV. Go to a site like Kelley Blue Book or Edmunds. Enter your car's information, year, make, model, mileage, and options. But be brutally honest about the condition. Don't choose excellent if you have door dings and coffee stains on the seat. Choose good or fair. This will give you a private party sale value. That's a good proxy for your ACV. Let's say it comes out to $5,000. Step 2. Look at your insurance policy declaration page. Find exactly how much you're paying per year for your collision and comprehensive coverages. It's broken down line by line. Also, note your deductible for each. Let's say you're paying $600 a year for both, and you have a $1,000 deductible. Step 3. Do the math. Your car is worth $5,000. Your deductible is $1,000. The absolute maximum possible payout you could ever receive from your insurance company if your car is vaporized tomorrow is $4,000. That's the ACV minus your deductible. To get that potential $4,000 payout, you are paying $600 every single year. Now ask yourself the critical question. Is it worth paying $600 a year to protect a $4,000 asset? A common rule of thumb many financial advisors use is this. If your annual premium for collision and comprehensive is more than 10% of your car's ACV, it's time to seriously consider dropping them. In our example, 10% of the $5,000 ACV is $500. You're paying $600. According to this rule, you should think about it. Next year, your car's ACV might be $4,300. The year after, $3,600. But your premium probably won't drop nearly as fast. Soon you'll be paying $600 a year to protect a potential payout of just $2,000. You are paying premiums that, over 3 or 4 years, equal the entire amount you could ever get back. You're essentially self-insuring on a very expensive, very slow installment plan. This is a profoundly personal decision. There is no single right answer. If that car is your only way to get to work and you have $0 in savings to buy another one, then paying that $600 a year might be the price you pay for peace of mind. But if you have a healthy emergency fund and could buy another $5,000 car tomorrow without breaking a sweat, then that $600 is probably better off in your pocket, invested, or used to pay down debt. The key is that you are making an informed choice, not just blindly paying a bill every 6 months. One giant exception here. If you have a loan or a lease on your car, you don't have a choice. The bank or leasing company that technically owns your vehicle requires you to maintain full coverage to protect their asset. You cannot drop collision and comprehensive until that car is paid off and the title is in your name. So we've established how to protect your own car from physical damage, and when it might be time to let that protection go. But we've only been talking about your property. This is the small stuff. The real life-altering risk in driving a car isn't what happens to your 10-year-old sedan. It's what happens when your 10-year-old sedan plows into someone else's $60,000 luxury SUV. Or worse, what happens when a moment of distraction causes an accident that puts someone in the hospital for months. This is where insurance stops being about fixing metal and starts being about protecting your entire financial future from evaporating. And it's all controlled by 2 little numbers on your policy page that are probably dangerously, terrifyingly low. We're talking about liability, being about fixing metal, and starts being about protecting your entire financial future from evaporating. And it's all controlled by 2 little numbers on your policy page that are probably dangerously, terrifyingly low. We're talking about liability. Liability coverage is the absolute, non-negotiable, most important part of your car insurance policy. And here's the secret nobody tells you. It has almost nothing to do with your car. Liability coverage isn't for you. It's for everyone else. It's the money that pays for the damage you cause with your 2-ton metal projectile when things go horribly wrong. It pays for the other person's medical bills. It pays for their lost wages when they can't work. It pays to repair or replace their car, their mailbox, their storefront, whatever you happen to hit. And most importantly, it pays for the lawyers to defend you when they inevitably sue you for everything you have. When you look at your insurance policy, you'll see your liability limits written as a series of 3 numbers, like 25/50/25, or 100/300/100. For years, most people just see those numbers, nod their heads, and move on assuming they're covered. This is a catastrophic mistake. Understanding these 3 numbers is the difference between a bad day and a ruined life. Let's break it down. The first number is the bodily injury liability limit per person. This is the maximum amount your insurance company will pay for any single person's injuries that you cause in an accident. The second number is the bodily injury liability limit per accident. This is the maximum total amount your insurer will pay for all injuries combined in a single accident, no matter how many people are hurt. The third number is your property damage liability limit. That's the max they'll pay to fix or replace any property you damage, whether it's 1 car or a 5-car pileup. Now, here is the terrifying part. Every state has a legal minimum amount of liability coverage you're required to have. And these state minimums are a trap. They are a financial time bomb. They are set so ridiculously low they are practically useless in a modern serious accident. They exist for one reason only: to give you a permission slip to drive legally. They do not exist to actually protect you. Let's take a common state minimum. Something like 25/50/25. 25,000 for one person's injuries. 50,000 total for everyone's injuries. And 25,000 for property damage. Let's see how that holds up in the real world. Let's imagine a scenario. You're a good driver. You've never had an accident. You're driving home from work, you're a little tired, and you glance down at your phone for just 2 seconds to check a notification. In those 2 seconds, the car in front of you, a brand new Toyota Highlander, slams on its brakes. You don't have time to react. You plow right into the back of it. First, let's look at the property damage. That new Highlander? It's easily a $50,000 vehicle. Your impact crumpled the entire rear end, bent the frame. The body shop declares it a total loss. Your insurance policy has a property damage limit of $25,000. So your insurance company writes a check for $25,000 to the other driver. Congratulations, you are now personally legally on the hook for the remaining $25,000 to replace their car. You just got a bill the size of a new car because you tried to save a few dollars a month. And we're just getting started. Now let's look at the people inside. There was a mother and her teenage son in that Highlander. The son has a broken arm and some bruising. He goes to the ER, gets it set in a cast, and has a few follow-up appointments. His medical bills total about $10,000. No problem, your $25,000 per person limit covers that. But the mother, she wasn't so lucky. The impact gave her severe whiplash and a herniated disc in her back. She needs an MRI, she needs to see specialists, she needs months of physical therapy, and eventually her doctor says she needs surgery. Her medical bills alone soar past $75,000. Your policy limit for a single person's injuries is $25,000. Your insurance company writes a check for $25,000. You are now being sued personally for the other $50,000 in medical bills. Your total bill right now between the car and the medical costs is $75,000. Your savings account is gone. Your kid's college fund is gone. But wait, it gets so much worse. The mother who needs back surgery? She's a dental hygienist. She has to stand and lean over people all day. With her back injury, she can't work. Her doctor says she'll be out of work for at least 6 months while she recovers from the surgery. She makes $60,000 a year, so that's $30,000 in lost wages. Who do you think pays for that? You do. And we haven't even mentioned the biggest, scariest part of any lawsuit: pain and suffering. This is the legal system's way of putting a dollar amount on the misery you've caused someone. The chronic pain, the inability to play with her kids, the stress of recovery. Her lawyer is going to argue that her pain and suffering is worth hundreds of thousands of dollars. So let's add it all up. You owe $25,000 for the car. You owe $50,000 for the initial medical bills. You owe $30,000 for the lost wages. And now you're facing a lawsuit for, let's be conservative, another $200,000 for pain, suffering, and future medical care. You are staring down the barrel of a $300,000 debt. Your 25/50/25 policy, which felt so safe, has been exhausted almost instantly. It was a paper shield against a financial hurricane. And this is where your life changes forever. Their lawyers won't just ask for the money, they will take it. They will get a judgment against you in court, and with that, they can garnish your wages for decades. A portion of every single paycheck you earn will be taken from you before you ever see it. They can put a lien on your house, meaning you can't sell it or refinance it without paying them first. They can seize the money directly from your bank accounts. Everything you've worked for, everything you ever will work for, now belongs to someone else. All because of a 2-second glance at a phone, amplified by a dangerously low liability limit you probably never even thought to question. Now, what if you had better coverage? What if, instead of the state minimum, you had paid a little bit more per month for a 100/300/100 policy? $100,000 for a single person's injury, $300,000 total for injuries, and $100,000 for property damage. Let's rewind. You hit that Highlander. The $50,000 car is totaled. Your $100,000 property damage limit covers it completely. You pay your deductible and that's it. The medical bills, the mother's $75,000 in bills are fully covered by your $100,000 per person limit. The son's $10,000 is also covered. The $30,000 in lost wages? Covered. The insurance company's lawyers will then step in to negotiate the pain and suffering claim. Because you have a respectable policy, they have a much stronger position to settle the case within your policy limits. The entire financial nightmare is handled by the company you pay to handle it. Your house is safe. Your savings are safe. Your future is safe. The difference in premium between a state minimum policy that will ruin you and a robust policy that will protect you is often shockingly small. We're talking about the price of a few cups of coffee or a Netflix subscription per month. There is no better return on investment for your financial security than increasing your liability limits. I want you to pause this video right now, pull up your insurance policy on your phone or in your glove box, and look at those 3 numbers. If you see a 25, a 50, or anything less than 100 in those first 2 spots, you are driving with a ticking time bomb strapped to your finances. Call your agent today and get a quote to raise them to at least 100/300/100. Better yet, 250/500/100. It is the single most important thing you can do. Because as terrifying as it is to cause an accident and be underinsured, there's another scenario that's just as dangerous. What happens when someone with a state minimum garbage tier policy hits you? What happens when they have no insurance at all? Now your medical bills are piling up, you can't work, and the person who hit you has nothing to give. That's when you find out if you protected yourself from them. This is where your entire financial future is decided. It's a single line item on your policy, often overlooked, that can be the one thing standing between you and absolute ruin. It's called Uninsured and Underinsured Motorist Coverage. Let's call it UM/UIM for short. This is the coverage that protects you from the very person we just talked about, the one with no insurance or a policy so cheap it might as well be nothing. It's not about protecting other people. This is about protecting you, your family, and your passengers. Think of it like this: your liability coverage is a shield you hold facing outwards to protect the world from you. Uninsured motorist coverage is a shield you hold facing inwards to protect yourself from the irresponsible people out there. And there are a lot of them. Depending on your state, as many as 1 in 4 drivers on the road with you right now has no insurance at all. 1 in 4. Let that sink in. This coverage is so important it's broken into 2 main parts, just like your liability coverage was. The first, and by far the most critical, is uninsured motorist bodily injury, or UMBI. This is your health insurance, your disability insurance, and your pain and suffering insurance all rolled into one when you're hit by someone with no coverage. Let's imagine a scenario. You're a nurse, let's call you Sarah. You work 12-hour shifts, you're on your feet all day, and you're driving home exhausted. You're stopped at a red light when suddenly, bam! A pickup truck going 50 never even hit the brakes. The driver was texting. The crash is violent. Your car is totaled. You're rushed to the hospital with a shattered leg, 3 broken ribs, and a severe concussion. The driver of the truck who hit you? He walks away with a few scratches and a ticket. He says he's sorry. He also says he doesn't have insurance. He let it lapse 2 months ago. He has no assets, no savings. He rents an apartment and works a cash job. You can sue him, sure. But as the saying goes, you can't get blood from a stone. Suing him is pointless. He has nothing. Meanwhile, you're in the hospital for a week. Your leg requires surgery with plates and screws. You're out of work for the next 4 months while you go through excruciating physical therapy just to learn how to walk again. The medical bills start rolling in. The ambulance ride, $2,000. The emergency room, $10,000. The surgery, $75,000. The hospital stay, $30,000. The physical therapy, $15,000. We're already at over $130,000, and that's not even counting the follow-up appointments, the medication, or the potential for future surgeries. Your health insurance helps, but you have a $5,000 deductible and a 20% coinsurance. So you're still on the hook for tens of thousands of dollars out of your own pocket. But the worst part? You can't work. For 4 months you have zero income. Your disability insurance from work only covers 60% of your salary, and it doesn't kick in for 90 days. You burn through your savings in the first month just to pay the mortgage and keep the lights on. The financial stress is crippling, worse than the physical pain. You're facing bankruptcy, all because someone else was irresponsible. Now let's rewind. Same crash, same injuries. But this version of Sarah was smart. When she bought her car insurance, she didn't just take the cheapest option. She paid an extra, say $15 a month for high-limit uninsured motorist bodily injury coverage. She matched it to her own liability limits. $250,000 per person, $500,000 per accident. In this reality, after the crash, she makes one phone call. Not to a bankruptcy lawyer, but to her own insurance company. She tells them, "I was hit by an uninsured driver." And her insurance company steps into the shoes of the driver who hit her. Her UMBI coverage pays for her medical bills that health insurance doesn't cover. It pays for her lost wages for the 4 months she couldn't work. It even provides compensation for her pain and suffering, the permanent limp she might have, the trauma of the event. Instead of financial ruin, she gets a check. She can focus on healing, not on foreclosure. That is the power of this coverage. But what about the underinsured part? This is just as sinister. Let's go back to the crash. This time, the guy who hit you does have insurance. He has the state minimum. In many states, that's just $25,000 for bodily injury. Your medical bills alone are over $100,000. His insurance company will write you a check for $25,000 and that's it. They fulfilled their legal obligation. You're still short over $100,000 and you're still out of work. You are financially destroyed by someone who was technically following the law. This is where underinsured motorist coverage kicks in. It covers the gap between your expenses and the other driver's pathetic little policy limit. So if your expenses are $150,000 and the other driver's policy pays out $25,000, your own underinsured motorist policy can cover the remaining $125,000, up to your policy limit. It's the safety net for the most common scenario of all: getting hit by someone who bought the cheapest insurance they possibly could. The second part of this coverage is for your car. Uninsured motorist property damage, or UMPD. This one is a bit more straightforward. If an uninsured driver hits your car, this coverage pays to fix it. Now you might be thinking, wait, doesn't my collision coverage do that? And you're right, it does. They often cover the same thing in this specific scenario. The key difference is the deductible. UMPD deductibles are often much lower than collision deductibles, sometimes as low as $100 or $250, compared to a $500 or $1,000 collision deductible. In some states, if you can identify the uninsured driver who hit you, the deductible is waived entirely. So, using your UMPD can save you hundreds of dollars out of pocket. If you don't have collision coverage on an older car, then UMPD is absolutely essential. It's the only thing that will fix your car if an uninsured driver damages it. So, the big question, how much do you need? The answer is simple and non-negotiable. You should have the exact same limits for your uninsured motorist bodily injury coverage as you have for your regular bodily injury liability coverage. Whatever you chose to protect other people from you, whether it's 100/300 or 250/500, you need to choose that same amount to protect yourself. Think about the logic here. The liability limit you chose represents the amount of financial damage you think you could cause in a serious accident. It's what you believe a person's medical bills, lost wages, and suffering could be worth. If you believe you need $250,000 to protect a stranger from the damage you could cause them, why on earth would you accept less protection for yourself or your own family? It makes no sense to value a stranger's well-being more than your own. Match your limits. Period. And here's the kicker. This coverage is shockingly cheap. We're often talking about a few extra dollars a month to go from having zero protection to having hundreds of thousands of dollars in protection. It is, without a doubt, the single best value in all of insurance. It's the one coverage people foolishly cut to save $5 a month, And it's the one they would pay any price to have after it's too late. Some states require it. Others force the insurance company to offer it and require you to sign a form to reject it. They make you put in writing that you are consciously choosing to be unprotected. Don't ever sign that form. We've now built a fortress. We have a shield facing out to protect the world from our mistakes, and a shield facing in to protect us from the mistakes of others. We've handled liability, but both of these shields only work when there's a person to blame, either you or them. What happens when there's no one to blame? What happens when a deer runs out in front of you on a dark road? What happens when a freak hailstorm turns your car into a golf ball? What happens when a shopping cart rolls across the parking lot and smashes into your door? Or when you hit a patch of black ice and your car slides gracefully into a telephone pole? In all of those cases, there's no other driver. There's no one to sue. There's no one's liability policy to make a claim against. So who pays then? That's when you find out if you have the two most commonly misunderstood coverages of all: collision and comprehensive. These are the two coverages that protect your car. They're what people are usually talking about when they use that dangerous, unofficial, and frankly misleading term, full coverage. Let's be crystal clear. There is no such thing as full coverage in the insurance world. It's a slang term. If you walk into an agent's office and say, "Give me full coverage," you might get something completely different than what you actually need. So let's forget that term and talk about what's real. Let's go back to our first scenario. You swerve to avoid something in the road and you hit that phone pole. Your front end is smashed. This is a classic collision. And that's exactly what collision coverage is for. It pays to repair or replace your car if it's damaged in a collision with another object, be it another car, a guardrail, a building, or that pesky phone pole. Now here's the part that blows people's minds. Collision coverage pays out regardless of who is at fault. Because the accident, it pays. If someone else causes the accident and they don't have enough insurance, it can pay. If you're the victim of a hit and run and you can't find the other driver, it pays. It is the safety net for the physical value of your vehicle in a crash. Think of it this way: liability coverage, which we talked about before, is for them. It pays for the damage you do to other people's stuff. Collision coverage is for you. It pays for the damage done to your stuff. Without it, if you cause an accident, you are 100% on your own to fix or replace your car. The other driver's liability insurance certainly isn't going to pay for it, and your liability insurance won't either. You could be left with a 1,000-pound paperweight and a car payment to go with it. So what about that deer? You didn't really collide with it in the traditional sense. It leaped out of the darkness. It feels different, right? It wasn't your fault. It was an act of nature. And insurance companies agree. This is where the second coverage, comprehensive, comes into play. Comprehensive coverage is sometimes called other than collision coverage, which is a terrible name, but it's actually pretty accurate. It's the bucket for all the weird, unpredictable stuff that can happen to your car when you're not even driving it. A tree branch falls on your roof during a storm? That's comprehensive. Your car gets stolen from your driveway? Comprehensive. Vandalized? Comprehensive. A hailstorm makes your hood look like a golf ball? You guessed it, comprehensive. Fire, floods, riots, hitting a deer or any other animal. All of this falls under comprehensive. It's the acts of God and mayhem policy. It covers things that are almost always completely outside of your control. So, in our scenario, hitting the deer would be a comprehensive claim, not a collision claim. This is a critical distinction because in many states, a comprehensive claim is less likely to raise your rates than an at-fault collision claim. Now, both of these coverages, collision and comprehensive, come with a very important string attached. It's a word you've definitely heard before, but you might not fully grasp its power over your wallet: the deductible. A deductible is simply the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. Think of it as your share of the repair bill. Let's say you have a $500 deductible for your collision coverage. You get into an accident, and the repair shop says the damage is $4,000. You pay the first $500 directly to the shop. Your insurance company then pays the remaining $3,500. If the damage was only $400, well, that's less than your deductible, so you'd be paying the whole bill yourself. It wouldn't even make sense to file a claim. You get to choose your deductible amount, and this is one of the most important decisions you'll make. The most common options are $250, $500, $1,000, or even $2,000. And here is the golden rule you must burn into your memory. The higher your deductible, the lower your premium. The lower your deductible, the higher your premium. Why? It's all about risk. If you choose a low deductible like $250, you're telling the insurance company, I want you to take on almost all the risk. I'm only willing to chip in a tiny bit. The insurance company says, fine, but you're going to pay us a lot more every month for that privilege. If you choose a high deductible like $1,000, you're telling them, I'm willing to share more of the risk. I'll handle the first $1,000 of damage myself. The insurance company sees you as less of a potential cost, so they reward you with a lower monthly or semi-annual bill. So which one should you choose? This is not a trick question. The answer is painfully simple, yet so many people get it wrong. You should choose the highest deductible you can comfortably afford to pay on a moment's notice. I'm not talking about what you could afford if you saved up for 6 months. I mean, if your car was wrecked tomorrow, how much cash could you come up with without having to sell a kidney or miss your rent payment? If the answer is $500, then you should not have a $1,000 deductible. Yes, the lower premium for a $1,000 deductible is tempting. Feels like you're saving money. But that savings is an illusion if you can't actually pay the deductible when you need to. Having a high deductible you can't afford is like having a locked treasure chest with no key. The money from the insurance company is in there, but you can't access it until you pay your part. Your car will just sit at the body shop useless until you come up with that cash. On the flip side, don't automatically go for the lowest deductible like $250. You might be paying way too much in premiums for a level of protection you don't really need. The difference in cost between a $250 and a $500 deductible can be significant over the course of a year. You might be paying an extra $150 in premiums just to save yourself $250 in the event of a claim. For many people, a $500 or $1,000 deductible is the sweet spot. It keeps premiums manageable while ensuring the deductible itself isn't a catastrophic, budget-destroying amount. The final piece of this puzzle is knowing when these coverages are required. If you own your car outright, no loan, no lease, you have the title in your hand, then collision and comprehensive are almost always optional. You can choose to drop them to save money, but you're accepting the risk that if your car is wrecked or stolen, you get nothing. However, if you have a loan on your car or if you're leasing it, the bank or leasing company that technically owns the vehicle will absolutely, 100% require you to carry both collision and comprehensive coverage, usually with a deductible no higher than $1,000. Why? Because it's not really your car yet. It's their asset. They're on the hook for tens of thousands of dollars, and they need to make sure that if you total it, their investment is protected. They use your insurance policy as collateral. If you drop these coverages, you're violating your loan agreement, and they can actually buy a policy for you at a ridiculously high price and tack it onto your car payment. So we've covered your liability to others. And now we've covered damage to your own car. We've built the foundation of a solid policy. But there's a huge gaping hole we haven't addressed yet. What about the most important thing of all? What about the actual human beings inside the car? What happens if you or your passengers are injured in an accident? Who pays for the ambulance, the hospital bills, the lost wages? And what happens if the person who hit you has zero insurance? You can't get blood from a stone, so who pays then? That's where things get personal. That's where things get personal. Because up until now, we've been talking about insurance that covers other people, or insurance that covers the physical metal of your car. Liability is for them. Comprehensive and collision are for your vehicle. But this next layer of protection, this is for you. This is the coverage that protects your body, your health, your ability to earn a living. This is the armor you wear. Let's start with the most straightforward piece of this personal armor. Medical payments coverage, often called MedPay. Some states have a more comprehensive version called Personal Injury Protection, or PIP, but the core idea is similar. MedPay is beautifully simple. It pays for medical and funeral expenses for you and your passengers if you're injured in an accident, up to a set limit, regardless of who is at fault. Let that sink in. Regardless of who is at fault. You could rear-end someone, an accident that is almost always considered your fault, and your MedPay could still cover the ambulance ride for your passenger. You could swerve to miss a dog and hit a tree, and your MedPay could cover your copay at the emergency room. It's first in line. No questions asked medical coverage for auto accidents. The limits are usually modest, think $1,000, $5,000, or maybe $10,000, but its power lies in its speed and simplicity. While the liability portion of an accident is being investigated, which can take weeks or months, MedPay can pay out almost immediately. It can cover your health insurance deductible. It can pay for immediate dental work if you chipped a tooth on the steering wheel. It's the fast-acting pain reliever of the insurance world, designed to handle the immediate financial sting of an injury, so you can focus on healing. Personal Injury Protection, or PIP, which is mandatory in no-fault states, takes this a step further. It not only covers medical bills like MedPay, but it can also cover a percentage of your lost wages if you can't work, and even essential services you can no longer perform, like childcare or house cleaning. It's MedPay on steroids. Whether you have access to MedPay or are required to have PIP, the purpose is the same: to provide an immediate financial cushion for your own injuries without having to wait for a long, drawn-out fault determination. But MedPay and PIP are just the first line of defense. They're designed for immediate, often smaller costs. They are not designed to handle the life-altering financial catastrophe that can be caused by one specific type of driver, the one who has no insurance at all. This brings us to the single most important coverage you might be skipping, the one that separates a terrible inconvenience from total financial ruin. I'm talking about uninsured and underinsured motorist coverage, UM and UIM. Let's go back to that nightmare scenario. You're driving through an intersection with a green light. A car blasts through the red light and T-bones you. The crash is violent. You're seriously injured, your car is totaled, and the other driver, who was clearly at fault, gets out of their car and says those dreaded words, "I don't have insurance." What happens now? Their liability insurance, which was supposed to pay for your medical bills, your lost income, your pain and suffering, it doesn't exist. It's a ghost. You can sue them personally, of course, but if they couldn't afford a basic insurance policy, what are the odds they have $100,000 in assets for you to claim? The odds are practically zero. So the bill for the ambulance, the emergency room, the surgeries, the physical therapy, the months or years you can't work, that bill now lands on your doorstep. This is how families go bankrupt. This is how homes are lost. All because someone else broke the law. Unless you have uninsured motorist bodily injury coverage, or UMBI. This coverage is your secret weapon. When you are hit by an uninsured driver who is at fault, your own insurance company steps into the shoes of the at-fault driver's non-existent insurance company. You file a claim with your own insurer, and they pay for your medical bills, your lost wages, and your pain and suffering, up to the limits you selected. You essentially buy insurance for yourself against the irresponsibility of others. And the numbers are terrifying. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. That's more than 12% of the cars you see on your daily commute. Every time you pull out of your driveway, you're rolling the dice, hoping you don't cross paths with one of the tens of millions of uninsured drivers. Having uninsured motorist coverage is deciding not to gamble with your family's future. But it gets even more complicated. What if that person who ran the red light does have insurance? You breathe a sigh of relief, right? Not so fast. What if they only have the state minimum required liability coverage? In some states, that can be as low as $15,000 or $25,000 for bodily injury. A single night in the hospital or one surgery can blow past that limit with ease. Let's say your total medical costs and lost wages come to $150,000. The at-fault driver's insurance pays out their policy limit of $25,000. What about the other $125,000? Where does that come from? Again, it comes from you. You are now being punished because the person who hit you is underinsured. This is where the second part of this protection kicks in. Underinsured motorist bodily injury, or UIMBI. This coverage fills the gap. It pays the difference between the other driver's low liability limit and the true cost of your injuries, up to the limit you chose for your own UIM policy. So, in our example, after you receive the $25,000 from their insurance, your underinsured motorist coverage could step in to cover the remaining $125,000. It's a financial safety net that catches you when another driver's inadequate coverage lets you fall. When you buy UM/UIM, you'll typically see the limits written just like liability, for example 100/300. This would mean your policy provides up to $100,000 per person injured in your car, and up to $300,000 total for the entire accident. The golden rule that many experts suggest is to carry uninsured and underinsured motorist limits that are at least equal to your own bodily injury liability limits. After all, if you believe you should have enough insurance to cover $100,000 of harm you might cause to someone else, doesn't it make sense to have that same amount of protection for yourself if they do it to you? Finally, there's a property damage component to this, often called uninsured motorist property damage, or UMPD. This works similarly but for your car. If an uninsured driver hits you and you don't have collision coverage, UMPD can pay to repair or replace your vehicle, usually up to a smaller limit. If you already have collision coverage, UMPD can sometimes be used to cover your collision deductible, which is a nice perk. It's an extra layer of defense specifically for your vehicle against the uninsured. So let's put it all together. MedPay or PIP is your immediate, no-fault medical fund. It's the first aid kit. But uninsured and underinsured motorist coverage is the trauma surgeon. It's the comprehensive long-term care plan that saves you from the catastrophic financial consequences of being in the wrong place at the wrong time with the wrong driver. It is, without a doubt, one of the most critical and yet most commonly misunderstood and undervalued coverages on a policy. It's not just an add-on. For millions of Americans, it's a necessity, because you can be the safest driver in the world, but you can't control the actions of the person in the lane next to you. And that brings us to the fifth and final car insurance basic you absolutely must understand. It's the one that directly addresses that terrifying reality. It's called Uninsured and Underinsured Motorist Coverage. Let's call it UM/UIM for short. This isn't just an option. In many states, it's a required shield against the unknown, and for good reason. Let me tell you about a guy named David. David was a graphic designer, 28 years old, just starting to hit his stride. He did everything right. He paid his bills on time, saved a little from every paycheck, and drove a modest, reliable sedan. He had good liability insurance, comprehensive collision, the works. He felt protected. One Tuesday afternoon, he was driving home from a client meeting, stopped at a red light, listening to a podcast. The light turned green. He proceeded through the intersection. And that's when a pickup truck, barreling through the red light at 50 miles per hour, slammed directly into his driver's side door. The crash was catastrophic. David spent weeks in the hospital, followed by months of grueling physical therapy. He couldn't work. The medical bills piled up, reaching well into six figures. His car was totaled. His life as he knew it was put on hold. But he thought, okay, this is horrible, but that's what insurance is for. The other driver's insurance will cover this. And then he got the news. The driver of the pickup truck had no insurance. Not a penny. He had let his policy lapse months ago. Suddenly, David's entire financial future was hanging by a thread. The at-fault driver had no assets to sue for. He was, in legal terms, judgment-proof. All those medical bills, the lost income from not being able to work, the permanent injuries he would have to live with, the responsibility for all of it was about to fall squarely on David's shoulders. This is not a rare one-in-a-million story. This happens every single day across America. The Insurance Research Council estimates that 1 in every 8 drivers on the road is uninsured. 1 in 8. In some states like Mississippi, it's closer to 1 in 4. Think about that. On your daily commute, you will likely pass dozens, if not hundreds, of drivers who have zero ability to pay for the damage they might cause you. This is where uninsured motorist coverage becomes your financial life raft. It steps in and acts like the insurance the other driver should have had. It is designed to pay for your bodily injuries, your medical bills, your lost wages, and even your pain and suffering when you are hit by a driver with no insurance. But there's a second, equally important part. Underinsured motorist coverage. This protects you from the driver who followed the law and bought insurance, but only the absolute bare minimum. Remember how we talked about state minimum liability limits? How some states only require $25,000 or even $15,000 for bodily injury? What happens if your medical bills are $100,000? If an underinsured driver hits you, their policy will pay out its maximum, let's say $25,000. Then what? Who pays the remaining $75,000? You do. Unless you have underinsured motorist coverage, your UIM coverage would then kick in to cover that gap, up to the limits you selected. It bridges the canyon between the other driver's pathetic policy and your actual devastating costs. Now, a common question I get is, well, I have great health insurance. Why do I need UM/UIM? It is a critical misunderstanding. Your health insurance is a fantastic tool for paying doctors and hospitals, but it does nothing for your other losses. It won't give you a single dollar for the 6 months of income you lost while you couldn't work. It won't compensate you for the chronic pain you now have to manage for the rest of your life. It won't pay for future surgeries you might need 10 years down the road. And it certainly won't cover the deductible and out-of-pocket maximums you'll have to hit first, which can be thousands of dollars. Uninsured motorist coverage is designed to cover all of that. It makes you whole in a way that health insurance simply cannot. When you look at your policy, you'll see UM/UIM limits, often written just like your liability limits, such as 100/300. This means you have $100,000 of coverage per person and $300,000 per accident. My advice? Your UM/UIM limits should, at a minimum, mirror your liability limits. Why would you want to provide more protection for a stranger you might hit than you provide for yourself and your own family? It makes no sense. The cost to increase these limits is often shockingly small. We're talking a few dollars a month for tens of thousands of dollars in extra protection. It is the single best bargain in the world of insurance. So let's bring it all home. We've journeyed through the 5 foundational pillars of car insurance. Number 1. Liability coverage. This is your shield. It protects your assets and your future from the financial fallout of an accident you cause. It's not about meeting the minimum. It's about creating a fortress around everything you've worked for. Number 2. Collision and comprehensive. This is the armor for your vehicle. Collision for crashes, comprehensive for everything else. Theft, fire, hail, a deer in the headlights. It's what ensures that a total loss of your car doesn't become a total financial loss for you. Number 3. The deductible. This is your stake in the game. The amount you agree to pay before the insurance company steps in. A higher deductible means a lower premium, but it also means more cash out of your pocket when you file a claim. You need to find your personal sweet spot between monthly savings and emergency fund reality. Number 4. Optional coverages. These are the personalized upgrades. Rental reimbursement that keeps you on the road, roadside assistance that saves you from being stranded, medical payments coverage that provides immediate first aid for your passengers, no matter who is at fault. And number 5. Uninsured and underinsured motorist coverage. This is your secret weapon. It protects you, your passengers, and your family from the irresponsible and the underprepared. It's the coverage that ensures someone else's bad decision doesn't become your lifelong financial burden. Look, I know this is a lot. Insurance is designed to be confusing. The jargon, the numbers, the fine print, it feels overwhelming. But at its core, it's simple. This isn't just a piece of paper you're legally required to have in your glove box. It is a contract that stands between you and financial ruin. It's the difference between an accident being a horrible inconvenience, or it being the single event that derails your life, drains your savings, and destroys your future. So here is your mission, should you choose to accept it. Sometime in the next 24 hours, I want you to do something very few people ever do. I want you to find your auto insurance policy. Don't just look at the price. I want you to actually open it up and find your declarations page. Find your liability limits. Are they $25.50 or are they $250/500? Are you protecting yourself or just the state minimum? Find your collision and comprehensive deductibles. Are they $500? $1,000? Do you have that amount sitting in an emergency fund, ready to go at a moment's notice? And most importantly, find your uninsured motorist limits. Do you even have this coverage? And if you do, are you protecting yourself as much as you're protecting others? Write these numbers down. And then I want you to pick up the phone and call your insurance agent or company. Don't be intimidated. You are the customer. You are in control. Ask them, can you explain my liability limits to me? Ask them, what would it cost to lower my comprehensive deductible from $1,000 to $500? Ask them, what would it cost to increase my uninsured motorist coverage to match my liability limits? You will be stunned by how small the price difference is for so much more peace of mind. Knowledge is not just power. In the world of insurance, it is protection. It is security. You are now armed with the foundational knowledge to have an intelligent conversation about your policy and to tailor it to your life, not just to accept the default option you were given. The road is unpredictable. Life is unpredictable. But with the right knowledge and the right protection in place, your financial security doesn't have to be. Drive safe and stay protected.